Hi, this is Scott McLeod with Brown Financial Advisory. Thank you for taking just a few minutes to allow us to discuss with you what's happening in the portfolio right now, and specifically with emerging market stocks. We have some concerns with regards to China and some of the things that are happening in our geopolitical environment, but also in their economic headwinds. We'd like to share with you that we plan to get the portfolio away from China, and there are some significant changes, but we wanted to share with you the reasons for those changes before we make them in the portfolio. Of course, I'm Scott McLeod, but I'm also joined today by Josh Lancaster. Josh is our Chief Investment Officer and has been working in the industry for over 25 years. He's going to share some of the specifics with regards to what's happening in China and how it impacts our portfolio and why we feel it's important for us to make these changes. First, there are some disclosures, and then I'll share a big picture view of what's happening. First of all, we'd like to recommend that we move the portfolio away from China. This means selling our emerging market positions and reinvesting in something that is an ex-China position. And the reason for that basically falls in three categories. Number one, we feel like there are economic headwinds in China that really can't be overcome in the short term. They have demographic issues where their workforce is aging, and the lack of transparency and some other things in their accounting methods that we really feel like are going to handicap China going into the next decade and maybe even beyond that. The second thing is that we really feel like that India is the next superstar in the emerging market space. The more money we have invested in China, the less we can invest in India, and we would rather focus our energies on that economic environment because they frankly are friends with the United States and also growing at a really rapid rate. We feel like that their technology focuses and some other things that are happening in India will really bode well for the portfolio. And finally, we think there are serious concerns with the geopolitical environment and what's happening with China and the United States. The Trump administration has not been friendly to China in the past, and it appears that the Chinese government has been using international hackers for purposes of espionage and also to undermine our infrastructure. And they also have a very strong relationship with Russia and South Korea, both of whom have sworn against the United States. So there are some very serious concerns in our emerging market space surrounding China, and we've decided to make this move in the portfolio as a result of those concerns. But I will let Josh right now share a few more specifics with regards to the portfolio, and he'll tell you exactly what we're thinking with regards to the Chinese market.
Thanks, Scott. The first issue we want to talk about is China's economic troubles. As you may know from the headlines, Bullet 1 points out China's real estate bubble and crushing debt. China has been trying over the years to boost its economic standing among the world's biggest economies, but money supply growth is cratering, purchasing indices are slowing, foreign investment has just about stopped, and consumer confidence is terrible. The government has tried various stimulus packages over the years, but to minimal effect. The government could alleviate its housing crisis, there's too much supply, by issuing bonds and purchasing the oversupply, but that would exacerbate its already high debt levels. Bullet 2 talks about many Chinese local governments are cash-strapped. So basically, these local governments are having to cut services and wages, especially in such critical areas as health and infrastructure. This has been leading to many protests, actually, across the country. And one example is a protest in last October by dozens of medical staff in the city of Xinhui on China's southeastern coast. Medical staff actually took over the hall of the public hospital there to demand wages and bonuses that have not been paid. And when you look at Bullet 3, this is an issue that we have been dealing with for a very long time. That is the lack of transparency and the interference by the Chinese central government with many economic stats like gross domestic product or GDP. This makes it difficult to trust the metrics that the markets use in their valuations. This also means that China will not be awarded developed market status until its markets and accounting systems become more transparent. Next issue we want to talk about is China's demographic troubles. China's population is aging faster than other major economies. The graph on the left of the page here shows the projected increase in people over 60, with China definitely leading the way on that. While the chart on the right shows that China has now dipped into negative population growth, or more deaths than births. The negative population growth is mainly from its one-child policy from 1980 through 2015, which the government has had a hard time overcoming, even with incentives for families to grow. You now have more retirees than you have new workers, which of course leads to bullet 2. Pension coffers are running low, and less goods and services are being produced. Next issue we want to discuss concerns the emerging market space and who really is the poster child or leader in that space. In bullet 1, we say that India is actually expected to replace China as that leader in emerging markets. And the graph on the right actually shows the percentage of China and India of the MSCI Emerging Markets Index. And as you can see in that graph, China's weight has been coming down since 2020, while India's weight is on the way up. So why is this? Well, we talked about that in bullet point 2, which says that India has a younger demographic, a growing middle class, a focus on technological innovation, and a link to the West. Well, contrast this with China's aging demographic, a property slump, and protectionism from the West. The graph on the left shows this bifurcation in outlook for these two countries. The graph shows whether global economies are facing long-term headwinds or tailwinds. Long-term tailwinds and headwinds are based on factors such as debt, demographics, and innovation. Near-term tailwinds and headwinds are based on things like labor, housing, spending, investment, and financial stability. As you can tell from the graph, India in the upper right quadrant is benefiting from both long-term and near-term tailwinds, while China in the lower left quadrant is facing all headwinds. And in bullet point 3, we talk about how there are some U.S. states that have instructed their public pension plans to remove Chinese investments. Those states currently are Indiana, Florida, Missouri, Oklahoma, Kansas, and Texas. The next issue we want to discuss is how China is a threat to the United States. And I am grateful for the Wall Street Journal's coverage of these issues. In bullet 1, we note that the Chinese government is involved in espionage against Western governments, companies, and citizens. In fact, we found out in 2023 and 2024 that hackers working for Chinese intelligence have been able to do things such as gain the ability to shut down dozens of U.S. ports and power grids, and also access cell phone lines used by U.S. government senior national security and policy officials. And in bullet 3, we note that Chinese ships have been accused of cutting undersea cables to disrupt data communications. And finally, China has close military relationships to North Korea in Russia's war with Ukraine. Both Russia and North Korea are avowed enemies of the United States.
Thanks, Josh. So to summarize, there are 3 bullet points again that we'd like to emphasize. Number 1, we're concerned about the Chinese market and its ability to grow from here. Their demographics are terrible. Their lack of transparency is awful in the global view. So we really don't think the potential in China is that great over the next 5 to 10 years. Second, we think that the Chinese market, because they are at this point of economic stagnation, is not the right emerging market to be involved in. We'd like to focus our energies elsewhere. They're not the superstar that they've been for the last 20 years, and we think there's an emerging superstar in India, and we would rather focus our attention there. And then finally, we're a little bit concerned about China and their threat to the sovereignty of the United States. Their hackers, the aggressive nature that the Chinese government has shown recently. We're concerned that the next 4 years for the Trump administration may be a challenge, and it will probably be reflected in the Chinese market as well. So we would rather dial away from that and potentially find opportunities in other parts of the portfolio. Thank you for the opportunity to share these thoughts with you. Please let us know if you have any questions. We're happy to hear from you. This is a big change in the portfolio, but we think it's good timing for this change. We look forward to seeing what happens in the opportunities to come. Thank you again.